Okay, we start chapter 6 today, but before we do, let's recap what's happening in the world. I think you can see the importance of a macroeconomics lecture and how things are playing out. We started out by trying to understand what are the key metrics in evaluating an economy. And we said it was the GDP and the unemployment rate. And we had we developed two pictures to explain the GDP and the unemployment rate. And then we said the way we analyze the economy is, for the most part, the economy functions on its own, but from time to time we get shocks to the system. And the shocks come from generally three sources: natural disasters, terrorists that don't like us, and bad public policy. And that creates a shock to either the supply or the demand curve, or both. And then the federal government, and then we need some help from federal government or the Federal Reserve to create a countershock. The actions taken by the federal government are referred to as monetary policy, and the actions taken by the Federal Reserve are referred to as fiscal policy. And we can see all of that playing out. In a nutshell, of course, we started this semester. If you remember, we started with a Wall Street Journal article on manganese. And we discussed in class as to how manganese prices were going up because it was used for fertilizers, but we were expecting a shortage from China because of the coronavirus. And boy, was it prophetic. That was supposed to be project for this semester, but things have moved along quite rapidly. And you can see where we are currently in terms of monetary and fiscal policy. Summarizing everything, we see a stimulus bill of about $2 trillion. Remember, the stimulus bill under the Obama administration to get us out of the housing crisis was $860 billion. Currently, we're looking at a $2 trillion stimulus bill. In addition, the Federal Reserve has committed itself to print about an additional $4 trillion. Just imagine that. The Federal Reserve's books already have $4 trillion on it, largely from the housing crisis. We've also seen interest rates, right? Around early March, they cut interest rates unexpectedly by 50 basis points. And then again by a total of 100 basis points, which we've never seen before, pushing interest rates all the way down to zero. So we can see what's been done in terms of monetary and fiscal policy. It's essentially pushed to the max. Okay, now, why is this crisis so huge? And you can think about it similarly. In a nutshell, it's a liquidity crisis. And we've seen the impact of liquidity crisis before. We saw this in, in 1998. Actually, it goes all the way back to 1992, when we saw Hurricane Andrew hit Florida, right? And the insurance companies were not prepared for it. And I'm going to connect the dots over here in a second, but there are four events I want you to keep in mind. There's the hurricane of 1992, there's the long-term capital hedge fund event of 1998, there was the housing crisis of 2007, followed by the sovereign debt crisis, and now we have the COVID-19 crisis. And they all have something in common in terms of the risk associated with it. It's a liquidity risk, and it's a risk that we don't anticipate because it's a largely correlated risk. I mean, just imagine if you're working for an insurance company and a company came up to you and said, look, we want to be able to insure against business losses in the event that there's a catastrophic outcome. Now, if that insurance company was selling business losses insurance to companies, right, it would generally think that it diversifies its risk. And the reason it believes that is, different companies run into trouble for different reasons. And what's the likelihood that every company in the world is going to run into business loss risk for some event. What's the probability of that? You'd say it's zero. But that's exactly the situation we face now. But if you go back to 2007, we asked, what's the probability that everybody's going to default on their loan at the same time? Should that happen in the US, right? And before that, you asked, for example, in 1998, when the long-term capital hedge fund, what's the likelihood that one hedge fund could bring around the entire market and have a financial catastrophe worldwide? Well, that was the liquidity crisis that could have resulted from the long-term capital hedge fund default, right? And then you go back to 1992, where we had Hurricane Andrew over here, and you ask, what's the likelihood that insurance companies that are insuring homes are going to run into trouble, where everybody's home is going to run into trouble at the same time, right? Generally, when you run into, you think about home insurance, you're thinking about a specific house springing a leak, and what's the probability that every house in Florida is going to spring a leak? It's pretty slim, until a hurricane hits and you find that every house in Florida has its roof blown up. So what happens over here is the characteristic of all of these is twofold. First of all, what we thought to be an uncorrelated risk that could appear suddenly turns out to be a correlated risk. And secondly, it results in a liquidity crisis. And what's the liquidity crisis currently? Well, before it was the housing crisis, but now it's a liquidity crisis for every business in America. Right? All of a sudden, who would have assumed that the demand for every company's products can go down to zero instantaneously? Right? We call it a black swan event, but calling it a black swan event is meaningless. All it says is an event we didn't expect. It's a low probability event. Right? It's not a low probability event. It's an event that we might not have expected, largely because we don't fully take into account of how correlated events can happen in society. And so this pandemic is an example of a correlated event, right? And it's a liquidity crisis. Why? Because when we get out of this pandemic event, which would not be too far in the future, right? The question is this: how many of these businesses can survive the margin call in the interim period? Right? If you have the stock portfolio and it went down and you got a margin call, you know your stock portfolio will go up sooner or later once this pandemic passes. But can you survive the margin call in the interim period? If you can't, they liquidate your position. The same thing with respect to businesses, right? They all have expenses, rents, employee expenses, insurance costs, whatever it is, utility bills. And the question is, with no demand for their product, they're essentially getting a margin call on their business. And if they can't put up the money to survive over this interim period, you don't survive that V-shaped recovery. What happens is you have to liquidate in the interim period. So the question is, we have a liquidity crisis, and can we survive the liquidity crisis? So we understand that if you have the funds, you can survive the liquidity crisis, and it's essential to survive the liquidity crisis. If you don't, what happens? You land up with an economy at the other end, which is largely devastated. So the entire role of the monetary and fiscal policy right now is to survive that liquidity crisis. So we make any amount of money available, right? Largely through the Federal Reserve and federal government. And in fact, the Federal Reserve has committed itself to buy any amount of bonds that the Treasury issues. So the government is essentially going to get a zero interest loan from the Federal Reserve to fund this crisis. So why would it not fund that crisis, the liquidity crisis, right? And so we'll have to see how this unfolds in terms of the bill, the $2 trillion bill. It's not yet passed, but they're working on it. And the Federal Reserve has already made a commitment. So the critical thing now, and for those of you monitoring the market and trying to figure out what's going to likely happen, remember our prediction at the beginning of the semester was the impact of coronavirus, and that's why we picked that as a project for this semester. I mean, there's no end to these liquidity shocks, these events that create a shock to the system, supply or demand. And so I'm always confident every time I teach this class, every semester I teach this class, that there's going to be one event that semester that's going to make up the subject of this project. However, this one is so bad that you're not going to be able to access Bloomberg to get futures prices for anything. So we have to figure out what type of end of semester project you have to do, because I doubt you'll be able to come back to campus the that's another issue, right? But for those of you who are monitoring the market, right, let me tell you, looking forward, what the critical thing you need to monitor is this. Right? Now, this whole crisis is not going to blow over until there is some indication that people can go back to work without fear of this COVID virus being a further problem. In other words, we have to have some temporary cure for this, some temporary cure. And there are several being considered. They come at 3 levels. One, of course, is the malaria drug, hydroxychloroquine, together with Zithromax. That's an antibiotic. That's one. The second one is there's some patients that is removing the plasma from some patients that have had COVID-19 but that have cured themselves, and so they have the antibodies in themselves, and those antibodies can be transplanted to other individuals to help them beef up their response, immune response. And the third one is the Remdesivir by Gilead, which is coming up with a antiviral vaccine, which is in the longer run. So all of these are different stages, but today, Tuesday, they started trials on all of these. Okay. And probably by the next time, the next week, we have our lectures over here, we'll have some resolution on this, right? Which is, we'll have a pretty good idea of how to control this. Now, there's one bit of information we don't have, and which you all should look out for, is that if you look at the data coming out of China, Wuhan, I mean, it peaked, the number of people that had this virus peaked, and then all of a sudden it went flat. Now, it's hard to imagine it going completely flat unless they have some sort of temporary remedy of this, right? Which the rest of the world, we know they've been doing these things, which is, using the anti-malaria drug. So there might be some results out there to which the US FDA and the CDC don't have the actual data. And so they're a bit cautious. But they're conducting the experiments right now in trials beginning in New York. The FDA has already given the okay for this drug to be used. And so and of course the drug takes effect, solves the problem in about 6 days. That was the research paper that was published by this French scientist just last Wednesday. What that means is in about a week to 10 days, we'll have a pretty good idea of whether this is a manageable problem. We go back to the economy. And should that happen, you can imagine how the stock market is going to react in less than a week. So that's the interesting scenario with respect to this. The important thing is how it ties into our class is, of course, we're trying to make predictions about which way the market is going to go based on our understanding of macroeconomics and the principles we apply to it. So that's one thing. But the more important thing is this: the underlying characteristics to all these catastrophic events, which is, whether it's a pandemic, whether it's a hurricane, whether it's a housing crisis, is it results in a correlated event and then a liquidity crisis associated with it. But as we know, in liquidity crisis, if you deal with it quickly, you get a sharp recovery. If you deal with it slowly, then you land up with a problem. Okay, so let's see what happens. Now, today we're going to start with chapter 6, interest rate futures. Okay, now this is a continuation of chapter 4, where, if you remember where we ended in chapter 4 was, I explained everything about bond prices, how you get the continuously compounded zero curve, how you get credit spreads, and how you develop trading strategies, either arbitraging bonds, or identifying hidden risk, or looking at credit spreads. And later on, I showed you how to get futures rates from zero rates, and based on those futures rates, I showed you how to develop trading strategies like writing the yield curve. So this is a continuation of the last part. Now, the last part of that, chapter 4, the key thing, aspect of that was this. We had this picture, 0, 1, 2. This is figures 4.4 and 4, I think 4.5. Table 4.5. Where we had the interest rate of 3% over here, interest rate of 4% over here, and we have a forward rate, a futures rate of 5% over here, right? And I took this one step further. Then I applied the Fisher effect equation to get inflation rates, expected inflation rates, and based on the macroeconomic environment, you can make your own prediction of expected inflation rates, and then develop trading strategies like riding the yield curve. But let's focus, so this picture went quite far, but let's focus on this picture for a moment, right? Which is, what we have is, from zero rates, you can get futures rates. That's the important thing over here. And we landed up with equation 4.5, the text, which is RF is equal to R2 T2 minus R1 T1 over T2 minus T1. This is equation 4.5 in the text, I think. Okay. So that was the key thing over here, which is we got one step further. I mean, we used the zero rates together with the credit spreads that came from the zero rates for all kinds of fun trading strategies. But what that gave us in addition to all of that is forward rates. Now, this equation can be used to calculate forward rates between any 2 points in time in the future. So it's a pretty simple and general equation, right? But unfortunately for us, what happens is you don't have a market for forward rates. So you can't write a contract with someone, a futures contract on rates. Like, you can't go somewhere and say, look, I want to make a deposit in year 1 for this period between 1 and 2. I'll deposit $1 million over here. Can I lock in an interest rate of 5% for that $1 million? So that's not the way contracts are written, okay? The way futures contracts on rates are written is they're actually written on treasury bonds, okay? So what we have over here is, instead of getting into a contract to deposit money over here for this period of time, the kind of contracts we have are, you get into an agreement over here, a futures agreement, to buy a treasury bond over here. And the treasury bond matures at this point in time. So the futures contract is not written on the bond, it's not written on a rate, it's written on the bond. And the futures contract is for the price of the bond. Okay, but you notice there has to be an arbitrage relationship between those two markets if it did exist. Now, the market for treasury bonds futures contracts exists. The market for just the rate doesn't exist. Okay, so this is a $1 billion opportunity. Anyone wants to create this new market, right? Where you would create a market for rates, and then you would hedge those positions as a provider of the service. You'd hedge those positions by taking the opposing positions in the treasury bond futures market. But notice, so for example, let me tell you how they're similar. Now, just imagine if I got into futures contract at time 0, right? To buy, and let's denote the futures price over here. The futures price at time 0 for a contract that matures at time 1. And I'm going to refer to a specific contract. This is a 1-year bond. 1 year, 0 coupon bond. Okay? So I want to get into a futures contract at time 0 to buy a 1-year, 0 coupon bond at time 1. And let's keep it simple. This zero coupon bond has a par value of $1. So you're going to buy a bond over here at this futures price. You're going to buy it over here, and then it's going to mature over here. So we're trying to figure out this futures price where you buy the bond over here. What would that futures price be? and the bond matures over here. So what would the futures price at time 1 be? To buy, what would the futures price be at time 0 to buy a bond at time 1 where the bond matures at time 2? Okay. So let's look at that. What I do is I have $1 over here. That's at the maturity of the bond. You get a par value of $1. And I ask, what would be the futures price you'd agree to pay over here? Well, that depends on what the futures rate over this period of time is. If at time 0 the futures rate is 5%, then the price over here, the futures price at time 1, at 0 to buy the bond at time 1 will be 1 discounted at an interest rate of 5% for 1 year. That is, all I do is I discount this 1 to time 1 at 5%. Because if I'm standing over here and the futures rate is this, right? What is the corresponding futures price at this point in time? The corresponding futures price must be equal to this $1 discounted at 5%, which is equal to this. If I discount it, you'll get this. And that's the futures price you'll agree to at time 0. So we land up with this relationship. F01 is e to the 0, 0, 5. That's it. No, minus. I discounted over 1 here. So you see the futures price over here to buy a bond at this point in time will depend on the futures rate over that period of time. So that's the arbitrage-free relationship. Because once you determine the futures rates from the 0 curve, the futures prices better be priced consistent with that futures rate. And therefore, the futures price is given by this. Okay, so the point over here is, it's just a matter of convention. What have we gotten used to? You know, if someone had done this exercise a long time ago to show that you could infer futures rates from the 0 curve, they might have started a market in futures rates directly. But the way the options and futures market developed was, we had futures contracts on some underlying. So we had a futures contract on corn, we had a futures contract on stock, and then we said, okay, why don't we have a futures contract on bonds? Right? So we began to write futures contracts on bonds as opposed to rates. But we know there's an arbitrage-free relationship between rates and bond prices. And this is how they're connected. So the futures price at time 0 to buy the bond at time 1 should be equal to this. And that price is determined by the futures rate for this period of time. Okay, so now we have futures contracts on bonds. Okay, but you can see very quickly how you run into trouble with futures contracts on bonds due to liquidity reasons. Because you ask yourself, okay, now, of course, the most important market for interest rate futures is futures contracts on treasury bond futures. That is treasury bond futures contracts. Okay, now, how many different types of bonds do we have? So I'm going to erase this because I need the space. Oh no, the whole purpose of this exercise over here is to draw the connection with where we ended in chapter 4 and where we're starting in chapter 6. We ended in chapter 4 with this concept of futures rates, and we're starting in chapter 6 with futures contracts on treasury bonds. Okay, so we're going from rates to bonds, but I want you to feel comfortable that there is a simple arbitrage-free connection between the two. in this sense. Okay? So having said that, let me get rid of all of this stuff. Okay, so now let's look at treasury bond futures. We ask ourselves, well, what are the two important characteristics about the bond contract which completely characterize a bond? And the two characteristics are the coupon rate and the maturity of the bond. So since we're only talking about treasury bonds over here, they all have zero risk. So generally there are three characteristics, which is the coupon rate and the cash flow. The coupon rate and maturity determines the cash flows. And then the third aspect is what is the risk of the bond, right? And over here we're talking about treasury bonds, so they all fall into the same riskless category. So let's create a metric over here, a box of all these treasury bonds that we can write futures contracts on. Okay. Here I'm going to put maturity. And over here, I'll plot coupon rate. And every treasury bond out there can be characterized by its coupon rate and its maturity. Okay, so I can create a two-dimensional graphical representation of the entire universe of all treasury bonds. And it'll be all these dots. The maturity, let's assume, goes from 0, maybe 1 week, to 30 years. And the coupon rate goes from, some small number, say from 0 to, say, 12. Because they could be, when were interest rates 12, 13, 14% in the early 80s? That's more than 30 years ago, so they're probably all mature. So you could get bonds, if we were creating this metric maybe 10 years ago, you'd see some coupon, you'd still see some bonds with coupon payments about 12%. But for simplicity, let's just keep a range. Let's say coupon rates are from 0 to 12, maturity from 0 to 30 years, and take every treasury bond I have over there, I simply figure out what its coupon and maturity is, and I create a dot corresponding to it, and this represents the universe, a graphical representation of the universe of all treasury bonds. And there are a hell of a lot of them, because first of all, we have a lot of debt outstanding, $22 trillion. Now it's going to go up to 24, 25. Federal Reserve books are going to go up from 4 to 8 trillion. So, remember I told you we don't seem to have much capacity, but we seem to find more capacity to print money. But coming back to this represents the universe of bonds. Now, suppose we were to write a futures contract on bonds. And since we have these thousands of bonds over here, God knows, thousands, 5,000, 10,000, a large number, whatever it is. If we had to write a futures contract on each and every bond, what's the problem we would face? If you write a futures contract on each and every bond, what would be the interest, what would be the liquidity in each of those futures contracts? It would be very low. Because if we had, say, 5,000 bonds over there, you'd have 5,000 futures contracts. How many people would be interested in trading each of those futures contracts? Not that many. And therefore, what would be the liquidity of each of those futures contracts? Not very good. So we wouldn't be able to create a market for each and every treasury bond. So we need a way around this problem. What are we going to do? Okay, so let me explain what we're going to do by giving you an analogy over here. Suppose we had a futures contract on lumber, right? And we specify the type of lumber that you have to deliver and the thickness of the lumber. Say we write And we write all kinds of futures contracts on. Some guy might want 3-inch thick, trunks, 5-inch, 7-inch, 10-inch, 50-inch, up to 20 inches. So now suppose, a hurricane came by and all the thin trees were blown over and only the big solid thick trees stood standing. Now, what if someone has written a contract and has to deliver lumber which is, say, 3 inches thick, but the only lumber he can find is 15 inches thick? Okay? What happens is, because this is a natural product, it becomes difficult to find exactly what you're supposed to deliver on that contract. The same thing applies to, say, orange juice futures. Suppose I get into a futures contract for orange juice futures and I want you to deliver pulp, but it has to have a certain color, acidity, and you don't want to be rancid. So what I'll do is I'll specify certain parameters of the acidity, perhaps color, or whatever metrics they have for orange pulp, right? And then you'll be allowed some flexibility to deliver orange juice pulp within a certain range of parameters. So what happens is, in all these cases, you have to have a certain amount of flexibility in the contract. So what we'll do is this. Go back to the lumber example, right? To try and avoid the problem that it's difficult to specify the contract exactly and to be able to deliver the items exactly according to that contract, what we'll do is we'll create one standardized contract, say in 12-inch lumber, right? So there's only going to be one futures contract, 12-inch lumber, but you can deliver any thickness lumber on that contract, right? So suppose the contract is one railroad boxcar of 12-inch lumber. The futures price is, say, $20,000. Now, you can deliver 14-inch lumber, one railroad boxcar 14-inch lumber, let's say, but the price is adjusted up by 10%. So it's not $20,000, it's $22,000. Or you could deliver 16-inch lumber, and the price is not $24,000, but $26,000. Okay? So we land up with what we call a contract, a base contract in 12-inch lumber, and a table. And the table allows you to determine if you deliver any lumber other than 12 inches. It could be 8 inches, in which case the futures price would be revised down. It could be 6 inches, and the futures price would be revised down even further. So, but the only contract that's traded and the only contract that's written is the 12-inch lumber contract. And with that contract is an associated table. And that table specifies how the futures price is adjusted based on what you deliver. Okay? And it's usually given in a percentage basis. The price will go up by 1%, 2%, 3% if the thickness of the lumber goes up by 7%. So imagine, what we land up with over there is only one futures contract. Now, what would the liquidity of that futures contract be? Pretty good, right? And how does that contract work with respect to delivering a whole range of lumber? It works pretty good. So that's the sort of system we have over here, which is we can't have a futures contract on each and every treasury bond. So what we're going to do is we're going to create a few futures contracts, right? Which are traded, and then you can deliver a range of bonds on those futures contracts. But this gets a little tricky, okay? Because just imagine, look, suppose we had one futures contract, whatever it is, now just imagine between, this is 0, this is T1, this is T2. Now, sometimes I'll use this notation when we're talking about interest rate futures, where previously we denoted the futures contract by F0T, where 0 is where you are, T is where the contract matures, and this is the futures price at time 0 for a contract that matures at time T. Over here, it may be convenient to represent the futures contract by 0, T1, T2, where 0 is when you get into the futures contract, T T1 is where you agree to buy the bond, and T2 is where the bond matures. Okay? Okay. So now, okay. So you can see, if I get into a futures contract at time 0, right? Between 0 and T1, when the contract matures, let's imagine one of two things could happen. Interest rates go up or down. So this is the interest rate R. It could go up or down. Now, at time 0, we don't know which way interest rates are going to go. Right? Now, suppose I write a futures contract on one bond. Right? And you can deliver any bond on that futures contract. Right? Look at the problem you run into. If interest rates go up, right, all bonds will drop in value. Right? All bonds drop in value, but which bonds drop most in value? So, this is scenario 1, where interest rates go up. This is scenario 2, where interest rates go down. When interest rates go up, all bonds drop in value. Right? Now, the guy who's going to deliver on that futures contract is going to do what? Okay? Now, let me explain how this delivery is made. Imagine you got into a contract to buy a house, right? And it's going to take 6 months to build a house. So the builder of the house says, I'll build you a beautiful house. I'll make sure you have tiles in the house, beautiful tiles. I'll make sure you have nice faucets by Moen and Kohler. I'll make sure you have a beautiful kitchen. You'll have a fridge, you'll have this, that, that. And he tells you all of this. And the house will cost $400,000. So you say, okay, we'll get into a verbal agreement. You deliver this house. Now, in 6 months when the house is delivered and you open up the door, right? The door is a bit rickety. But the contract says you'll have a main door at the entrance. It doesn't specify exactly what the door would be made of, what type of lumber, what type of quality. And of course, since it didn't specify that, what type of door is delivered to be the main door for your house? It's the most rickety door you can find. Then when you walk into the house, true enough, you see tiles, right? But except they are these little tiles that you might find in a public bathroom. That's in a third world country. That's my own history. Anyway, you see these terrible tiles over here. And the guy said, look, I told you I'll have tiles. These are tiles. But you were imagining nice big tiles, put at an angle. None of that came true. But notice, he is sticking to the letter of the contract. He's put tiles. He has appliances, but the cheapest appliances he could find. Right? So the bottom line is this. Whenever someone writes a contract to deliver something, what they will do is they will deliver the cheapest item that they can deliver that will satisfy the contract. Okay? That's just human nature. Okay. So now let's come back to the bond thing. You agreed to buy a bond at a particular price. And this guy said, okay, I'll deliver a bond for you for the par value, say $1,000. You agree on that. Now, in the interim period, after you agree to buy the bond for $1,000, interest rates go up. All bonds drop most in value. Okay? Tell me where the bonds in this metric are that drop most in value. Since interest rates have gone up, bond prices drop. But which duration bonds drop most in value? The one with the longest duration. And the longest duration bonds are over here with the lowest coupon rate, highest maturity in this column. Right? And if you tell the guy, look, on this futures contract, you can deliver any bond over here from this universe of bonds. Which section of this universe would he deliver bonds from? this section. Okay, on the flip side, suppose in the interim period, interest rates go down. All bonds go up in value, right? So the guy is going to say, oh my God, if all bonds go up in value, is he going to deliver 30-year bonds that have gone up significantly in value? No. He's going to deliver bonds from where? The ones that have, over here, short maturity, high coupon payments. Because shorter maturity, higher coupon payments have the lowest duration, right? And lowest duration means their value went up the least. So, over this interim period, all bonds have gone up in value, and he has to deliver a bond. And the crappiest bond he can deliver is the one that's gone up least in value, which is from there. So you can see what happens over here. If you had one futures contract and you can deliver any bond you like, right? You can see at time 0 you have to agree to the futures price. At time T1, when it comes to deliver the bond, the guy with the short position has the benefit of hindsight to see which way interest rates have gone, up or down. The guy who delivers the bond, that's the guy with the short position, at time 1 will decide, have the benefit of hindsight to see which way interest rates have gone. And based on that, he will pick bonds from a particular end of this universe of bonds to satisfy that contract. Now, at time 0, does the guy with the long position know which way interest rates are going to go? Well, it's hard to predict, right? He doesn't know where interest rates are going to go. They may go up, they may go down. But if I give this guy an opportunity to deliver any bond on this contract, notice you're giving the guy an exceptional flexibility, right, in terms of finding the crappiest thing in the universe he can find to deliver. Okay? So, in a nutshell, what this is like is, imagine, you had some friends over. You have a big house, many rooms, a lot of delicate stuff all over the place. And they have a couple of naughty kids, right? And the kids go running around from one room to the other, to the other, to the other, and they're breaking all kinds of stuff in your house, right? So you can imagine this is the house. They're going all over the place and they're up to no good, right? After a while, you get a little fed up and say, okay, you guys, next time you come over here, you guys are staying in this room. You're staying in one room in the house, right? Because I know the more flexibility I give you guys, the more you run around these rooms creating trouble, right? So I'm going to give you very little flexibility. You stay in this room and you don't move. So I know you can, I sort of minimize the trouble you create for me. So that's the sort of thing I do over here. If I let the guy with the short position deliver any bond in this futures contract, right, he has too much flexibility to play games. And I have to limit the ability that he has to play games. So I have to put him in a box. Now, the tightest box I can put him in, like a little kid, I can put him on a chair and tie him to that chair and say, that's where you sit. Right? And that guy can't be up to much mischief. The counterpart over here is, I can write a futures contract for each bond. If I write a futures contract on this bond, that's the only bond you can deliver. That's it, you can't play around. But that's a bit of a problem, because then I have to have a futures contract on each and every bond. If I have a futures contract on each and every bond, I don't have liquidity in the market for each bond, I'm back to square one. So that's where I have to reach a middle ground where I can't be too restrictive on what you can deliver, right? But I can't give you too much flexibility either. So what we land up with is 4 types of treasury bond futures contracts. Okay? And if you're following the textbook, let's look. I'm looking at page 135 of your text, section 6.2. You all should turn to that now. And it reads right on top. Table 6.1 shows interest rate futures scores. One of the most popular long-term interest rate futures contract is the Treasury Bond Futures contract traded by the CME Group. In this contract, right, any government bond that has a maturity of between 15 and 25 years to maturity on the first day of delivery can be delivered. A contract, yeah, okay. Okay, so this is referred to as the T-bond contract. So this is the Treasury bond contract, and you can deliver any bond in this range. $15 to 25 years. So what we've done is we've created one box over here. Okay, so this is the T-bond contract, Treasury bond contract. It's called the Treasury bond contract, and you can deliver any bond with a maturity of 15 to 25 years. Then there are three other contracts. If you go to the next paragraph, you'll find the 10-year, 5-year, and 2-year contracts. Okay? And it says that in the 10-year contract, you can deliver any bond from 10 to 6.5 years. So I create another bin. Maturity of 10 to 6.5 years. There are plenty of bonds over there. This is the 10-year contract. So for a 10-year contract, you can deliver any bond with a maturity of 6.5 to 10 years. Then we have the 5-year contract and the 2-year contract. In the 5-year contract, now it doesn't say in the textbook, but the 5-year contract, you can deliver any bond from 4 2/3 to 5 1/4. I'm not 100% sure of this, so y'all can look that up. In some older editions of this textbook, I think he mentioned it's in the range of 4 2/3 to 5 1/4 years. But I'll leave it to you all to check that out. And then, so this is the 10-year, this is called the 5-year contract. And then we have the 2-year contract, where you can deliver any bond between 1 3/4. Again, you need to check this out. He doesn't give this in it. Between 1 3/4 and 2 1/4. But you all need to check this out. Some range over here. So what we land up with is 4 contracts. This is the 2-year contract. Okay. So now for the 2-year, so we land up with 2-year, 5-year, 10-year, and the T-bond contracts. Okay? For each one of these, there's a range of maturity bonds that you can deliver. So this is standardized. Okay. But notice, so what we've tried to do is, instead of letting this guy run amok, the guy with the short position is the guy with the short position has to deliver the bond. It's just like when you get into a contract to buy a house, the guy with the short position on the house who delivers the house is the builder of the house. When it comes time to deliver on a contract, they're always delivering crap. You know, whatever the contract is. You have to assume that at least. Okay, so what we've done is, by creating these 4 contracts, we've reduced the size of this big bin where you have a whole range of flexibility, and we've mitigated the flexibility you have. So your range of maturities is short over here, right? So you can't run around. You still have rooms to play around. Like when interest rates go up, you'll deliver bonds from this corner. When interest rates go down, you'll deliver bonds from this corner. But at least that's a little more restrictive than if you were unrestricted and you could deliver bonds from these 2 extremes. Okay, but that's one so. But the other aspect of this, so we've accounted for how to mitigate the problem with the range of maturities that the guy with the short position has the ability to deliver the range of maturities, but you still have the opportunity to play with the coupon payment, right? Because if you write a futures contract on a bond, right, the guy with the short position will say, okay, I'll deliver a bond, a 15-year bond, but I'll deliver a zero coupon 15-year bond. But a zero coupon bond is a lot less valuable than a coupon paying bond, right? So you say, oh boy, how do I limit the ability for you to play games? That is, who's the one playing the games? The guy with the short position. How do I limit his ability to play games in choosing the coupon payment of the bond that he delivers? Well, the way we deal with that is like we dealt with the lumber case, right? So when it comes to coupon, what we're going to do is we're going to write the contract on a standardized coupon rate, and that's 6%. So what we'll do is we're going to draw a line over here, 6% coupon, and I'll draw these lines over here. Okay, so when we talk about a treasury bond contract, right, you can deliver not any bond. The futures price is written on one bond, but it's written on the 6% coupon bond, right? And if you deliver any bond in this box that's not 6%, we're going to adjust the price. So if you deliver a higher than a 6% coupon bond, that's more valuable than a 6% coupon bond, right? What we'll do is whatever remember you agreed to a futures price for a 6% coupon bond. If you deliver a bond that is more than a 6% coupon bond, then we'll adjust the price up so that when you deliver a more valuable bond, because it has a higher coupon rate, you'll be paid a higher price on that delivery. If you deliver a lower coupon bond that's less valuable, we'll adjust the futures price down and you'll be paid less upon that delivery. So, in other words, the contracts are written on these red lines, right? So you can deliver any bond in this maturity range, but this coupon payment. You can deliver any bonds in this maturity range, but this coupon payment. Same here and same here. And if you deliver any bond, remember you can deliver any bond in this bin. If you deliver bonds above this, 7, 8, 9% coupon, we'll adjust the futures price higher and higher so that when you deliver a more valuable bond, you'll be paid a higher amount. So the futures price will be scaled up for higher coupons and scaled down for lower coupons. So the bottom line is this. What this picture represents is as follows. We have 4 treasury bond futures contracts. Each contract is written for what? For a certain set of parameters, and that's denoted by this red line. Any maturity in this range and a 6% coupon bond. Any maturity in this range, 6% coupon. Any maturity in this range, 6%, and same over here. And you can deliver, if you deliver any for different maturities, there's no adjustment in the price, you're entitled to deliver. But if you deliver any coupon above or below 6%, it's going to be adjusted in price to account for the fact that it's more or less valuable. Okay? So what we need to do is, we need to figure out, when we have these 4 contracts, remember, like the lumber example, the futures contract is written on a 12-inch lumber, right? And we need a table associated with the futures contract to ask you how the futures price is adjusted up or down on a percentage basis, depending on the different thickness lumbers you think. And that table has to be written up front, because you need to know, this is the futures price. The base case contract is for 12-inch lumber. It's $20,000 a boxcar. That's the base case contract. That's the only contract that's traded. Now you can deliver 14-inch lumber, but the table says the price will be adjusted up from 20,000 by 10%. You can deliver 10-inch lumber that's down from 12 inches, but the table will say the futures price from 20,000 will be adjusted down by 10%. So that's what I mean by the table, to adjust the delivery price depending on what you deliver. So what we land up with is as follows. We land up with 4 futures contracts, right? And for each of those futures contracts, we have a table. A table that says how the futures price is going to be adjusted up or down from the base case contract, right? The base case contract is written on the red lines. That's the only futures price you observe. But when you deliver a bond, right, what you'll get for it will be adjusted depending on what? Whether the coupon rate is high or low, and we need that table. We need to be able to set that table up front, because when you get into the contract, people need to know what the futures price for the base case contract is, which is the 6% coupon bond, and what the table is as to how the prices will be adjusted up or down if you deliver a different coupon bond. So you see, that's quite challenging, right? Okay, so that's what we're going to do. Now, so even before we can go down this picture, we have to build some machinery, first of all. And remember, this is the Treasury bond futures market. So before we go into the Treasury bond futures market, we need to go into the spot market for Treasury bonds. Because the spot market for Treasury bonds has some quirks that we need to sort out. Okay? Once we understand how the spot market for Treasury bonds work out, then we can talk about the futures market on those spot market bonds. Are we okay? Okay. So let's get rid of this picture. You don't need this anymore. Okay, so let's start with bond prices in the spot market. Okay, let's set up this timeline. This is 0. This is in months. So I'm standing over here. Okay, now I'm the market maker, right? I have to, for any bond out there, I set a price for it. I post it on Bloomberg. People can see that price, and then they can make a decision of whether they want to buy it at that price or not. This is pretty much like the spot market, like the spot market for stocks. What the market maker on NASDAQ or the NYSE posts a price for the bond, for the stock, a bid and an ask price, and then you see the price, and then you decide whether you want to buy or sell, the number of shares you want to buy or sell. However, in the bond market, it's a little irritating for the market maker, because what happens is, suppose the market maker is trying to set bond prices on a particular date, right, for some bond, and that bond has some coupon payments, right? And the next coupon payment on this bond is going to be, is it going to be on one of these days, 6, 12, 18? No, the coupon payment is going to be on that 6, 12, 18 mark, only on the issuance date or a coupon date, coupon payment date. Because if a coupon has just been paid, then the next coupon payment is going to be in 6 months. Or if the bond is just issued, then the next coupon payment is going to be in 6 months. But on any other day when bonds are traded out there, when is the next coupon going to be? It's going to be anywhere between 0 and 6 months. So the next coupon payment can be anywhere over here. You could get a coupon payment here, and then 6 months later you get the next coupon payment, and you get the next coupon. Okay? So that represents the timeline of coupon payments for any bond that the market maker wants to set the price for. So now the market maker sets the price for that bond. How is he supposed to set it? Well, you know how to get the continuously compounded zero curve, right? From chapter 4 for Treasury bonds. Well, what the market maker should do is, for this particular bond, take all these coupon payments, find its present value at the continuously compounded zero curve, and post the price here. Price at 0. That's the price. So you could do that and post it. Now, what happens 1 day later? 1 day later, look what happens to all the coupon payments. They move 1 day closer. So what should the price be the next day when the market maker posts that price? Well, all the coupon payments have moved 1 day closer. He has to do a new present value calculation based on that zero curve. And then what happens the next day, and the next day, and the next day, and the next day? Okay. Now, imagine the market maker has to deal with thousands of bonds, and imagine going back in time 20, 30 years where we didn't have computers and we're working with the abacus. How's the market maker reacting to calculating all these present values every day for all these thousands of bonds? Each day goes by and there's not much trading any one particular bond because there are a lot of bonds in this market. That's a whole lot of calculation. Okay? So this was the environment we were in when this convention was set up. Of course, things have changed since then, and now we could do things a lot more differently, but a lot of institutional aspects of this market have stuck on. Okay, and institutional aspects of markets are difficult to change. Like you can see, for example, I showed you how to get continuously compounded, using the continuously compounded zero rate, how to calculate arbitrage-free forward rates. So why don't we have markets on forward rates directly? Why do we need futures contracts on bonds and not rates? Well, that's how the institutions develop. So there's an opportunity over here to create new markets. That's what I'm telling you. But the bottom line is this. So the market maker is a little pissed about doing this over and over again. So he sets up a simple convention. What he does is this. Each time, let's get rid of all of this. Okay. Let's suppose a coupon payment has just been paid. Okay? So the coupon payments of the next payments are here. Fall exactly on this time. Okay? What the market maker will do is calculate the present value over here of these coupon payments. So this is the price at zero. That's that price. So this is the price immediately after the last coupon payment. Okay, calculates the present value of that using the continuously compounded zero curve and posts that price. Now, imagine a situation where the interest or the zero curve doesn't change much from day to day. Okay, so what happens is that each day goes by, all these coupon payments shift closer and closer and closer and closer. Right? But what the market maker does is, he doesn't change the price. That P0 is the posted price. He leaves that price over there. Right? And then, so when you go up and check on Bloomberg, the price you observe is not the price, say 1 day, 1 month has gone by. Suppose 1 month has gone by and the coupon payments now look like this. Or say 2 months has gone by. Now the coupon payments are at 4 months, 10 months, and 16 months. Okay, it's important to understand this figure. The red coupon payments represent where the coupon payments were immediately after the last coupon payment, where I set this price. Right? Once I set that price, I never change that price. I just leave it over there. Okay. Then, 1 day after another goes by, and 2 months have gone by. As 2 months goes by, when is the next coupon payment? At 4 months, 6 months, 8 months, that's 16 months. 4 months, 10 months, 16 months, right? But the price that's posted on Bloomberg is still this price. And that price is 2 months old. Right? So somewhere comes along and says, okay, he observes this price which is 2 months old and says, okay, I want to buy at this price. Okay, this price is called the quoted price. Remember, the quoted price is set after the last coupon payment. Okay. 2 months goes by, and we see the new revised line in green of the coupon payments. And somebody comes along 2 months later and says, he observes this price, and he says, okay, I want to buy this bond. And the market maker says, sold. But the price you have to pay is not this, right? You have to pay what we call the cash price. This is the quoted price. You pay the cash price. Remember, this price is 2 months old. That's the price you saw posted on Bloomberg. But that's not the price you pay. What you pay is this. The cash price will be equal to plus what I call the accrued interest, AI. Now, what do I mean by that? What the market maker will say is this. Look, this price that you saw on the computerized system was something I posted 2 months earlier. You've walked in now, right? If you had bought it 2 months ago at this price, you would have got your next coupon payment 6 months later. But you're coming in now, 2 months later, so your next coupon is going to come in 4 months, right? So what has happened is this. The new guy will be holding the bond for 4 months, and the market maker, the last coupon payment was when? At -2. Remember the timeline? All of these coupon payments have gone down. The last payment was at -2. So what has happened is, since the last coupon payment at -2, the market maker held on to the bond for 2 months, and the investor will be holding on to the bond for 4 months before the next coupon payment. So the market maker says, look, this next coupon, right, that is to be paid, we need to divide that up among ourselves, because I held on to the bond for 2 months before I sold it to you. So I should get 1/3 of this coupon payment. And that is 1/3 how? Because the total period is 6 months. He held on it for 2 months. So 2/6 is 1/3. And the new investor who buys the bond now will hold on to the bond for 4 months before the next coupon payment. And therefore he should get 4/6 of that next coupon payment. So the market maker wants 2/6 of the coupon payment because he held on to the bond for 2 months. Because remember, the coupon payment comes on every 6 months. So the market maker wants 2/6 of the coupon payment, and 4/6 of that coupon payment will go to the buyer of the bond. So the price over here, this accrued interest will be what? This will be 2/6 of the coupon payment. So what the market maker will say was, this was the price you saw, right? But the price you paid, the cash price is what you paid, will be what you saw plus 2/6 of the next coupon payment, because the market maker says, I held on to this bond for 2/6 of that period, and therefore I want 2/6 of the next coupon payment. So your cash price will be, so quoted price is what you observe on the Bloomberg system. The cash price is what you pay. What you see is not what you pay. What you pay will be adjusted for what you see plus the accrued interest. And the accrued interest is calculated by the fraction of the interest that the market maker wants for the fraction of the period that he held on to the bond before he sold it to you. Okay? So now we need to figure out how to calculate this accrued interest. Because in this example, I kept it simple in the sense that there's 6 months between payments. The market maker held on to the bond for 2 months, and he just wanted 2/6 of the coupon payment. But strictly speaking, right, the next coupon payment could be not 4 months away, but could be 13 days away, 14 days away, 19 days away. This fellow could have held on to it for 46 days, 47 days. So, because prices change, things are changing on a day-to-day basis. So, what we have to figure out is a general method to calculate the accrued interest. And the accrued interest is simply the fraction of the interest that the market maker gets for the fraction of the time that he holds on to the bond since the last coupon payment. Okay, so to calculate the accrued interest, there are 3 methods to calculate it. The first one is called actual over actual, 30 over 360, and actual over 360. So let me explain each of these. Now, the accrued interest needs to be calculated as accurately as the market is liquid. If the market is very liquid, right, then we want bond prices to be calculated as exactly as we can, means the accrued interest has to be calculated exactly as we can. So, this is the case for treasury bonds. For corporate bonds, where the corporate bonds are not very liquid, right? So, I mean, to calculate the accrued interest, we don't have to come up with a super accurate method to 13 decimal places if we don't know what the bloody price of the bond is in the first place because it's not liquid. So, for corporate bonds, we use this method. I'll explain each method. And actual over 360 is what we use for money market securities. For securities that are less than 1 year in maturity, so you can see it's a hybrid of these two. We use the actual in the numerator and 360 in the denominator. So let's see what each of these means. Now, for those of you following the textbook, for those of you following the textbook, okay, on page 132, this is the very beginning of chapter 6, and at the bottom of page 132, you see the 3 periods, actual over actual, 30 over 360, and actual over 360. So let's see what this means. And we can see this by way of an explicit example. And I want you to see that example on page 133. Okay, so just beneath the business snapshot at the top of page 133, I start with reading. The actual over actual day count is used for treasury bonds in the United States. This means that the interest earned between 2 dates is based on the ratio of the actual number of days elapsed to the actual number of days in the period between the coupon payments. So, let me explain that. So, for over here, for example, we're assuming a bond principal of $100, a coupon payment of 8%, a coupon rate of 8%, and suppose we wish to calculate the interest earned between March 1st and July 3rd for a bond where the coupon payments are paid on March 6th and September 6th. So let me summarize all of this to you. Okay, what we have is coupon payments are paid on March 1st and September 1st. Okay? So these are the coupon payment dates. And I want you to keep this picture in mind with this picture. Okay. And you want to calculate, suppose somebody wants to buy the bond on July 3rd. So this is July 3rd. So you're standing over here, somebody wants to buy the bond over here. And so remember we need to calculate the accrued interest. Okay, so you calculate the accrued interest by the actual number of days that the market maker holds on to it, divided by the actual number of days. So let's put actual okay, and for this bond, it's an 8% coupon bond, so the coupon payments are 4 and 4. Okay, so now let's see how we calculate this. Let's calculate the days in each month. So what we'll end up with is March. How many days are in March? 31. April has 30 days. May has 31. June has 30. July has 31. August has 31. So that's 6 months. Okay? Remember, we're going from March 1st and the next coupon payment is September 1st. Okay? So, how many days are there between March 1st and September 1st? You have to be a little careful with the counting. We ended with August 31st, right? So look, how many days are there between March 1st and March 2nd? We don't say there are 2 days, it's 2 minus 1, that's 1 day. Is that clear? So when we say September 1st, right? How many days are there between March 1st and September 1st? What you'll find is, you go to March 2nd, 1 day, 2 days, 3 days, up to March 31st, 31 days. So when we come to September 1st, we just have to count up till August 31st. Because recognize each day is from March 1st to March 2nd is 1 day. Right? So when you hit March 2nd, you don't say you've hit 2 days. Is that clear? You've only hit 1 day. So, when you hit September 1st, you only have to count the number of days till August 31st. Okay, so let's add up all of these number of days over here. 30, 30, 31, 184 days. That's the actual number of days. This is equal to 184. The actual number of days between March 1st and September 1st. Now, what is the actual number of days between March 1st and July 3rd? So March, there are 31 days. April, there are 30 days. May, there are 31 days. June, there are 30 days. And in July, how many days are we going to count? Is it 3? No, it's 2 days. Because it's like going from the 1st to the 3rd. How many days are there from the 1st to the 3rd? 1st to 2nd is 1 day. 2nd to 3rd is 2 days. Okay? So if I add all this up, I'll get 124. So what is the accrued interest? The accrued interest for the actual over actual method is 124 over 184 times 4. That's the fraction of the time. 124 over 184. That's the fraction times the coupon payment. So that fraction of the coupon payment will go to the market maker. That's the actual over actual. Now, what about so this is the actual over actual method. What about the 30 over 360 method? What will that be? Look at the denominator. In the 30 over 360 method, we assume that there are always 30 days in the month, regardless of which month it is. And there are 360 days in the year. So what happens is, if coupon payments are exactly 6 months apart, from September 1st to March 1st to September 1st, and there are 30 days in a month, then then we calculate this to be 180 days. And then over here, if they're just 30 days in a month, 30, 30, 30, 30, and the final 2 days. That is